Let's talk about price to earnings now, which is my favorite valuation methodology. So by the end of this section, you will understand what PE is, or price to earnings, why it's important to value a company, and how the process works. Okay, so price to earnings is very similar to price to revenue, except a company is profitable and you really factor in the growth rate more often when you do PE than when you do price to revenue. And that's called a PEG ratio, or PE to G. I'll show you in a second. Okay, so a company usually trades on a PE that's in line with its growth rate. Okay, that's just the way it works. And so an example is that a company that has earnings growing at 20% per year usually trades at a price earnings multiple, or a PE multiple, of 20 times earnings, right? Close enough. And a company that has earnings growing at only 10% per year trades at 10 times earnings, okay? So it trades at a discounted price earnings valuation because it's growing at half the growth of the other company listed above there. So it should trade at a 50% discount because growth is 50% lower, okay? All right, great. So the stock market usually trades around 15 times earnings, okay? Around that amount. And that's because the stock market usually has earnings growing at around 15%. This methodology is very easy. Okay, so if a company misses earnings estimates by, say, 20%, like say they report earnings after hours, and they miss by 20%, the stock usually gaps down 20%, okay? There's a gap in the chart, and vice versa. Okay, so price to earnings is the same thing as market capitalization divided by net income, okay? And a PEG ratio, that's PE to G, or price earnings to growth, measures the PE relative to its growth rate, okay? So stocks that usually have a PEG ratio below 1 are cheap, and stocks that have a PEG ratio above 2 are expensive, okay? And it all depends on what market environment we're in. So a company that trades at 20 times earnings, right, and has earnings growing at 20% has a PEG of 1 times, okay? That's good value. And a company that trades at 20 times that has earnings growth double that, or 40%, trades at a price earnings to growth rate of 0.5 times. And this is often a bargain, right? Usually a good buy idea. Now, a company that trades at 20 times earnings and has a growth rate of 10% is expensive, right? It trades at a PEG of 2. And quite often hedge funds look to short this type of company.